Hello everyone, welcome to ThinkWealth 6789. Like many of you, I'm working a full-time job while learning how to better understand financial markets and investing. This channel is where I share what I'm learning about the economy, markets, and long-term investing without hype and without the complicated language. In today's video, we will break down the three major forces shaping the markets in 2026. Number one, the interest rate. Number two, oil and geopolitics. And number three, the earnings and what they mean for everyday investors in Singapore and the region. 2026 isn't a normal year. Rates are shifting more slowly than expected. China's recovery is uneven, and a global geopolitical surprise, including the recent capture of Venezuela's President Nicolas Maduro, briefly shook the entire oil markets. All these events connect, and they influence how investors behave. So let's break it down clearly. Number one, interest rates and liquidity. Everything in the market starts with the cost of money. In 2025, the US Federal Reserve slowed down interest rate cuts because parts of the inflation, especially services and housing, stayed sticky. So instead of fast rate cuts, we entered 2026 expecting only 2 or 3 small cuts, and markets adjusted to a higher for longer environment. And why US rates matter to Singapore? Well, for Singapore, US rates matters because our exchange rate is managed against a basket heavily linked to the US dollar. When US rates stay high, borrowing stays expensive, property financing stays tight, and growth stocks need real earnings to justify valuations. So in 2026, the market rewards companies with actual cash flow, not just big promises. For investors in Singapore and ASEAN, growth stocks may move slower unless earnings rise. Strong REITs benefits when rates fall. Global ETFs remain popular, and the US dollar directions affects your returns directly. Well, number two, oil and geopolitical risks. Rates tell us the first part of the stories, but geopolitics can move markets too. In early January 2026, the world reacted to surprising news. American forces captured Venezuelan President Nicolas Maduro during a major operation. This was unexpected because Venezuela hosts some of the largest proven oil reserves in the world. Oil prices briefly moved in both directions as markets tried to understand what this meant for supply. Some traders expected future supply to increase if Venezuela's oil industry stabilizes. Others worried about political uncertainty affecting production. But overall, markets treated this as volatility, not panic. Safe haven assets like gold lifted slightly, which showed investors were alert, not fearful. And why, again, this does matter to us in Singapore? Well, because oil influences transportation costs, energy bills, food prices, and inflation expectations. When oil stabilizes, inflation becomes easier for central bank to manage. If oil becomes volatile, Monetary Authority of Singapore (MAS), which is the Central Bank of Singapore, stays cautious and delay easing. So geopolitical events like this are part of the inflation story, not noise. And China enters 2026 with mixed signals. The property sector remains weak in China, but exports and electronic manufacturing are gradually improving. For investors, this means growth in China will be selective, not broad. In contrast, ASEAN continues to benefit from supply chain diversifications. Countries like Singapore, Malaysia, and Vietnam attract new business investment. This supports tech, logistics, and financial services, and it makes Southeast Asia one of the more resilient regions in 2026. Good news is Singapore remains a safe haven and stable investment hub. Retail investors' participation is rising, and global companies continue expanding regional operations here. For local investors, this means both global and regional opportunities remains open, depending on your risk appetite. The third and final force shaping 2026 is earnings. Last year was full of hype around AI, tech, and the new business models. But in 2026, markets want proof, not promises. Tech companies are moving into a profit phase instead of expansion at all costs. Industrials and energy companies benefit from global infrastructure spending. Investors are more cautious, but not bearish. And market sentiment is steady. Investors are not chasing speculative trades like in 2021, but they are not hiding either. They are watching inflation reports, interest rate decisions, earnings beats and misses, geopolitical developments. This is healthy and it makes the market more predictable. So let's simplify everything. When you think about 2026, think about three forces: rates, oil and geopolitics, and earnings. Put together, they help you understand what is driving market beyond headlines. And that's all for today. Thank you for watching all the way to the end. It really means a lot, especially for my very first video on this channel. If you found this helpful, do subscribe to ThinkWealth 6789. I'll be sharing simple, calm insights like this every week. In the next video, we'll talk about big questions many of us have. How do you know if the market is just dipping or if it's the start of the real crash? Stay tuned. Thank you and goodbye.